Welcome back. Here we are. We made it. Quant Bros, episode 7. I had a solo episode 6.5 prior to this, and we're going to lean into that a little bit. We got some fun topics. We're going to talk a little bit about Bitcoin conference. We're going to talk about Bitcoin as energy. We might have a little bit of back and forth. Go over the MicroStrategy multiple on net asset value chart over time and think through the S&P 600. We're going to expand into it a little bit more. Talk about the difference between QQQ and S&P 500, why they're different. Talk a little bit about stock split. I've done a little bit of analysis over the last couple of days on some historical stock splits, but there are some topics that are kind of fun to think about. Talk about ideal candidates for a Bitcoin strategy, which will be interesting. I mean, I think founder-led companies have got some good opportunities on the horizon. And then look into implied volatility of some of those equities that could potentially take a Bitcoin strategy. So let's jump right into it. Hey, man, how are you?
You know, what's going on? How are you? How'd you enjoy the Bitcoin conference?
Well, I didn't go. So, I was at home and pretty relaxed, honestly, but watching everything from the sidelines, it was fun. Twitter was alive. Everybody was sharing the special feeds. Pretty crazy that multiple political candidates are talking about Bitcoin. It's even part of the conversation. I've talked to many relatives about it. My father-in-law sent me an article this morning from the Seattle Times of Donald Trump embracing crypto. And I think it might have said embracing Bitcoin. And there's a whole article, which is interesting. I mean, it's hitting the boomers in the Seattle Times. Right. I think a lot of people expected the price of Bitcoin to just rocket after Donald Trump or Robert F. Kennedy talk about Bitcoin. But if you think about the people that may invest in Bitcoin after seeing something like that in their traditional media channels, we're probably 14 days out from them moving capital and buying a Bitcoin. Maybe 21 days out, maybe 30 days out. Like, it might be a month after that event before people start to think about it, realize it, orange pill themselves, get orange pilled by somebody else. These things take time, and moving capital takes a decent amount of time as well. I think I remember when I moved capital from my HSA to buy MicroStrategy, it took 2 weeks, and I had to get a physical check via snail mail, and I had to write a separate check and send it to another bank via snail mail, uninsured, had no idea where it was at any point in time, and just had to trust that the USPS was going to get it there. So it takes time to move capital sometimes, accounts and access Bitcoin ETFs in different vehicles. So I wouldn't freak out if the price of Bitcoin continues to go down or, whatever. Also, there's the historically, the Bitcoin conferences tanked the price.
Right.
If you look back at history. But anyway, what were your thoughts?
Yeah, I mean, look, I think it's absolutely nuts that we have, major political candidates addressing Bitcoin in such a favorable way because of the clear and present, check that it would provide against the state in terms of their ability to, spend above their revenue. And when I'm talking about the government, their revenue is the taxpayers, taxes that they pay. But the privilege of being the world reserve currency is that they can really spend above those means, spend above the taxpayers' means. Whereas something like Bitcoin, it obviously provides that 21 million, you cannot spend above this. It's binary, you either have it or you don't, and it's not debt-based. And look, here's the thing on this, and maybe this is a broader point here. I think a lot of the narrative stuff that people have been talking about, with whether it was, the Jim Biancos of the world in early January 2024, who said things like, the narrative of Bitcoin has completely changed. It used to be cypherpunks in 2009 and 2010, and now it's BlackRock and the rest of the other Wall Street firms. And it's Well, no, because there was nothing I could have done to have stopped that from happening. And it's the same thing that we're seeing today in regards to whether it's people thinking like that the nation state of America and other nation states are going to collapse because of Bitcoin. That's like the most extreme example, and one that like I don't support whatsoever. Or people thinking that like, you know, Bitcoin as a money only is going to become like the world reserve currency. Whether either of those things happen or not, Bitcoin can still flourish in that environment regardless.
Yeah. So one thing that I brought up in my last video, Ryan, was Donald Trump talking about having a ton of energy, right? Which is an interesting topic, and you know, I think you are in the camp that energy is not necessarily the problem; it's the storage of energy that's the problem. And I've got this concept that I've been playing around in my head is that Bitcoin is is stored energy, and it is the energy money. So can Bitcoin act as a de facto storage vehicle, right? Like, is it a storage vehicle?
So here's the thing, because we're kind of bouncing around between like the literal and the abstract. And you and I just briefly talked about this, where I said, you know, I agree with Saylor in the notion that like capital is energy, because it can be immediately transferred to whatever it is that you want to transfer it to, right? I can, you know, go walk down the street and pick up a hot pizza. I didn't pick the grain or the flour or put the tomato sauce on it. I just picked up the hot product, and I used like a small amount of capital to make that transaction. Or you can scale that up to being able to like buy things like planes or, you know, buildings like skyscrapers in Manhattan. You can scale it and everything in between. That's the abstract idea, though, like money as energy, and the notion of being able to like send it back and forth. That's the abstract piece. In the literal piece, though, energy, you know, literal energy, heating your home, putting gasoline in your car, putting electricity in your Tesla car, that's, you know, real life functional energy. And to your point about like the storage or generation, I'm no energy expert, so I'm not claiming to be, but from what I've gathered from like reading actual energy experts, because I'm pretty interested in this stuff, is that it's not the energy generation that is the problem, i.e. using things like natural gas or oil to generate energy. It's the storage / transportation issue involved with energy. Because on the transportation front, there's X% of it gets lost the further distance it travels. Yeah. Plus, people and systems and machinery expect energy on demand. A la, you know, turning computers on and off, or turning hospital machinery on and off. So this is why I think like the ultimate solution is like Tesla megapacks.
Battery packs.
And clearly I'm like talking my other book over here, but like I see megapacks as being like a way bigger business than the car business. Like I think we should almost just like stop selling cars, or like deprioritize that, because every like local government, every state government, like it behooves them to have, you know, massive amounts of megapacks so that they can just store excess energy and trade it back and forth to the grid with auto bidder software. And that's the kind of stuff that gets me like, you know, keeps me bulled up on Tesla. But there's definitely a distinction there, right? Back to the main point about the abstract, Michael Saylor, you know, Bitcoin is energy. I get that, but there's also like, you can't put Bitcoin in your gasoline car and expect it to go forward piece, you know?
Yeah. I think it all kind of depends on, or not depends on, but the generation of an economy on a Bitcoin base would help facilitate that, right? Like if you had, alternatively, if you had a gas station that accepted Bitcoin for payment, does that do it? You know, like starting to think about an economy on a Bitcoin baseline is really fascinating, because you could start to think about, you know, alternative alternative ways that energy is going to be consumed, right? Like you're totally right. We've got over the next 10 to 20 years, we've got an enormous demand, period. Electric cars, AI, computer development, and Bitcoin, proof of work, cryptocurrency. And on top of the existing demand that we already have. Now, granted, you probably have like a little bit of a population decline, or at least the rate of change of population is slowing. So
in America?
In America, the rate of change is slowing.
Higher.
The rate of change is going higher?
Higher.
No. Population is going higher. The rate of change, the delta, the rate of change is decreasing.
I misspoke there. You're talking rate of change, because I think immigration is going to keep going higher, but there would be reason to believe that a Trump presidency, the rate of change would decline nonetheless.
Immigration is going higher. Yeah, I mean, there are other countries that their population is definitely increasing. I mean, the world population is definitely increasing, so demand is obviously going to be continuing to increase. But the rate of change, at least in America, is slowing down, and most developed countries like UK, Japan, most developed countries, the rate of change is actually decreasing. So, on top of existing demand, there's going to be increased demand from these other components. But the function of Bitcoin is that it incentivizes future electricity development, and you can instantly monetize it if there's not population or the future of, like, let's say your battery packs are, like, your mega packs are 5 years out, but you got them ordered. It's like ordering an airplane from Boeing. It takes a decade to get it. Same with the battery packs. Like, you're going to order a mega warehouse battery pack, and they got to go steal the lithium ion from another country and make them first, right? Like, they've got to go do that. However, you could still build the infrastructure in the meantime and park Bitcoin miners there until your mega packs get there and your future infrastructure is developed. And then once all of that future infrastructure is developed and you've got AI, computing power, and mining software, and data warehouses sitting there, once that's developed, the Bitcoin miners are going to go to the next spot. Like, where's the next cheapest energy?
Right.
And it's going to be this constant, like, cycle of, like, Bitcoin miners are going to keep getting pushed out to, like, the edge of, like, wherever the cheapest electricity is. I also think there could be a potential future where Bitcoin mining could be subsidized in the US if people, this is a positive view that I see on Bitcoin, is like, if the United States adopts Bitcoin holistically, right? It might take a decade, it might take 20 years. I wouldn't be surprised if they subsidized people to have Bitcoin miners operating at their house. And it continues to increase the strength of Bitcoin holistically and increase the diversified nature of Bitcoin. And basically, everybody could be able to vote on, like, whether to adopt the newest Bitcoin software or whatever is going to be a vote on your house. Like, just like you have an air conditioner unit on your house, like, you might have a Bitcoin miner right next to it. And it's a concept that I think would be interesting, but it would increase the strength of the network, increase United States dominance, increase, like, the continued development of the network. I could see that being a thing, probably by the time I'm significantly older.
I don't know, man. I feel like I'm so bearish on the idea of government adoption, like, relative to where you are, because I know what your view is. I mean, I just struggle so hard with this idea of, like, either legal tender or, like, America actually fully adopting Bitcoin, because let's be clear, like, the orange man who is on the stage is a reality TV star who will say or do whatever he has to say or do in the public eye to, like, stay relevant. So there's absolutely no guarantees here.
100%.
And then to also just on the more broader adoption piece as well, like, that's one piece. The other piece is I just don't know if this is going to end up being something that's adopted in the way, like, iPhones are, in terms of, like, everyone wanting to have one. I don't know if mining is going to be adopted in that way, where, like, or perhaps air conditioning is the better analog here, because you mentioned air conditioning. everyone wants air conditioning, but I'm not sure if like everyone's going to want to have like a Bitcoin miner on their house. And again, by the way, that cannot happen. Bitcoinization might not happen, and a lot of these other like narrative driven things might end up not happening, but Bitcoin can still end up going up more than everything else just by virtue of its characteristics.
Yeah.
You know?
Completely agree. Yeah. It's I mean, the horizon's long, right? I mean, this is going to outlive us. So you know, I might have 60 years left.
Yeah.
And who knows where technology is in 60 years? Fuck, I could have 100 years left. You know,
sure, yeah.
It's who knows? As long as I keep pumping weights behind me, right?
That's the key. That is.
Anyway, it's a fun topic, and there's a lot of things to be really positive about right now. I mean, it's the 9th largest asset on the planet, and it's got a lot of room to grow. In looking just at like what NVIDIA lost $800 billion in the last month, and that's almost the market cap of all of Bitcoin. That's pretty crazy. So, you know, I think we've got a long ways to go. I think there is a repricing happening. I think we will see continued volatility in the markets, at least until, I think there's a Fed meeting tomorrow. Is that right?
This week, yeah. Is it tomorrow?
Yeah.
Tomorrow's Wednesday.
Tomorrow. Yeah. So anyway, some interesting stuff on the horizon. But should we switch gears, talk MicroStrategy?
Yeah, let's do it.
Get into everybody's favorite topic. I might have to pour myself a little bit more whiskey. I've got Boulder Spirits American Single Malt. This is a good one, if you can tell. So,
you're such a gentleman with these scotches and whiskeys, you know.
You know, COVID. Everybody figures out hobbies and stuff, right? Like, I got into whiskey a little bit. It's kind of fun.
It's a fun one.
All right, so I'm going to share my screen. And we're going to go over here, share my screen. Let's start with this one. So I talked about this on, I guess, Quant Bros 6.5 solo, where I brought up this idea. So this is the MicroStrategy multiple on net asset value. For those who are listening on the podcast, I encourage you to check out YouTube. Because we do a lot of visuals. Ryan and I like to see things visually. I think it really helps. So what I looked at here is the MSTR tracker website. So this is the data from the MSTR tracker website, which is looking at the multiple on net asset value over time at different Bitcoin prices. So the reason I created this is I was looking back historically at some of the older multiples on net asset value. Right at the very beginning, when MicroStrategy first adopted their Bitcoin strategy. And I was curious as to why the multiple on net asset value was significantly higher than it is today. And if you think about, and you know, I'm biased because I have this perspective of X and the people investing in MicroStrategy, but I think there are significantly more people investing in MicroStrategy today than there were back in 2020 when MicroStrategy first adopted their Bitcoin reserve strategy. So the question was, why did it trade at a higher multiple on net asset value when people didn't even think about this metric back then compared to today? And so when I started looking at the data, I segmented out the data into different time periods, and I categorized the data into different time periods with the perspective of passive index fund investments into MicroStrategy, particularly the S&P 600. MicroStrategy was historically in the S&P 600. The S&P 600 is basically a small version of the S&P 500. It's for small cap stocks. I think you have to have a market cap between something like $1 billion and $5 billion. You need to have positive earnings over the last 12 months. And most of the other characteristics are exactly the same as the S&P 500. It's just for small cap stocks. So the S&P 500 the S&P 600 back in 2020 had held 578,400 shares in these three S&P 600 index ETFs. So it's the iShares, IJR, the Vanguard, and the Spider. So those 578,000 shares represented about 4.45% of the shares outstanding. And if you pull even just Michael Saylor's shares out of that number, just go to 11. It actually represents around 5.26% of the shares outstanding, just pulling Saylor's shares out. So that's a significant number of shares. And when we look back at the net asset value analysis over time, because of the accounting rules for digital assets, once MicroStrategy adopted their Bitcoin reserve strategy, they had to start taking earnings hit on an accounting basis for the lowest price of Bitcoin during that period. And they weren't able to take the benefit of the high price during the period. So basically, it turned their earnings per share data, and I've got the earnings per share data here on the screen. You can see before their earnings, before they adopted the Bitcoin strategy, the trailing 12-month earnings were very positive. $3 a share, $4 a share, $2 a share. And then after the very first quarter of their Bitcoin adoption strategy, they came out with a $1.50 negative earnings per share. And it basically flipped the trailing 12 months earnings almost negative. At that point, it was almost signaling to the market, if the price of Bitcoin continues to go up and be volatile, up and down, it's signaling to the market that MicroStrategy is going to get nailed on an accounting basis and the earnings per share is going to go negative. And as you can see, after the Q1 earnings release in 2021, the earnings per share, trailing 12 months earnings per share for MicroStrategy went from 12 cents to negative 78 cents to negative $12.25. That effectively wiped out all of the historical earnings for the last 3 or 4 years for MicroStrategy. And so when you think about how the stock market works, right? Everybody knows all of the information as soon as possible. So basically everybody's front running everybody on everything, and everybody's trying to get an edge on data. So when you think about earnings per share and like companies falling in and out of indices, this is 100% baked in and cooked into like every single algorithm that is trading equities. Everybody's trying to front run passive indices across the board because it's something that's static, it's consistent, and they know when buyers are coming in and coming out. So when we look at back at this time series, you could see, when they were trailing 12 months positive earnings, they were trading at a significantly higher multiple on net asset value. As the earnings went negative, these green dots over here, you can start to see that the multiple on net asset value began to come down. And once it was very clear that they were no longer qualifying for the S&P 600, you can also very clearly see the net asset value dropped pretty materially. And once they were removed from the S&P 600, all of these purple dots, you can see that the net asset value dropped even further and was trading about 1 times the value of the Bitcoin, and often well below the value of their Bitcoin holdings. And moving forward, you can see this trend improve. So Saylor sold 400,000 shares at the beginning of 2024. That was from January 1st to like April 15th. That's all of these red dots outlined here. And the Bitcoin ETF also came out. Once Saylor was done selling shares, you could also see these little yellow dots. You can see an improvement in the net asset value going up a little bit higher. And once MicroStrategy was announced to be added to the MSCI index, again, further improvement, and it's another layer of base support on MicroStrategy stock. So I like to think of this as like a layer cake. I don't know if it's going to be linear. I don't know if it's going to be exponential, but I think there's going to be layers of kind of baseline support that are going to come from passive indices. And I think there's a probability greater than zero that with the inclusion of in QQQ and the S&P 500, I wouldn't be surprised if we start trading at multiples that are in this range or higher, given the relative scale and size of the S&P 500 or the S&P 500 and QQQ relative to the S&P 600. It's significantly more capital that can be allocated to it. Now, Jeff, you may say that, well, I'm just gonna sell my MicroStrategy shares at a premium and buy Bitcoin. It's like, yeah, you could do that. Anybody can make that trade, and there will be people that are going to trade that forever. And yeah, I think it's a little bit of an inefficient trade, but what was the other point I was going to say there? Anyway, I think let's shift gears. Ryan, you got anything to add on that before I go to the next chart?
Yeah, I mean, several things. Number one, great overview on the layer cake. I mean, I love this. I watched it, your video either last night or the night before. Really had a lot of like major takeaways from it, and the main one I'm going to touch on is going to be S&P 600 here in a second. But before that, one of the things that I've seen a ton on Twitter is people saying things, like what should MSTR's mNAV trade at, or why is it up this much in this day, or why is it down this much in this day, and those sorts of things. And it's like, I have no idea where it's going to go, and to your point, whether the move from here, either up or down, could be linear, exponential, non-linear, any of these things, like we don't know. But the thing that I do feel like I can say with confidence is that it's not going to be like a static thing. No. And I think this is a fundamentally massive misunderstanding in traditional finance, where people think in terms of like fair value, or once we get past this Fed FOMC meeting, then we'll have clarity on something, and then like values will fall back into our like subjective perception of where like value should be. And that's just never the case of reality, especially with assets that move in the way that MicroStrategy, Tesla, Nvidia, Bitcoin, in the way these sorts of things move. It never seems to be balanced or linear or any of that sort of thing.
Another question I get asked a lot is, okay, well, if they get added to the S&P 500 or QQQ and it rockets, and if there's a bear market and turn down, are they just going to fall out of the index? I think it's a fair question. I think there's a lot to unpack with that. If you think about the S&P 500, they would need to have a market cap less than 14 billion. I think the price on that is around $700 at today's float. So I really doubt it's going to drop back down to $700. I think at this point, I think there's a very low likelihood. So if you think about even just any base layer support greater than what there is today, I think there's an incredibly low likelihood that if they get added to the S&P 500, they ever fall out of it ever again. Because you've got the price of Bitcoin, you've got Bitcoin support, you've got a new Bitcoin ETF, and you've got new buyers that are buying Bitcoin, as opposed to like retail plebs that are buying this stuff and putting it in cold storage. You now have BlackRock and all of these ETFs that are buying it. So you've got a different mindset of the investor too, right? Anybody that's buying the Bitcoin ETF, like they may have it in their, IRA. And if you have it in your IRA and you can't touch it for 20 years, that money's locked up. It's not going anywhere. And that type of buyer is going to continue to buy and continue to hold for the long term. And so I think the concept of a bear market in Bitcoin, I think it will still exist. I think we will still see bull markets, and we'll still see bear markets. But I think the relative proportion of the bears are going to be much lower than the past. given just the pure game theory of it, right? Like everybody may stop buying at the same time, knowing that the bear market's coming. But every traditional finance buyer is going to have a lower pain tolerance than the retail pleb. So, like, if the price falls 20%, they might buy more. So I think the TradFi support is going to, I think, float the bear markets a little bit higher than they've dropped in the past. I could be wrong, but I think we're going to see significantly higher DCA levels. We're going to see significantly larger double downs in bear markets, et cetera. Especially anybody that's invested in the Bitcoin ETF right now, if the price of Bitcoin goes to 200,000 and they liked it at 60,000 and they like it at 200,000, they're going to be buying it at 100,000. They're going to be buying it at 150,000. So it's just we're in a different era. And I think that's like just super important to think about. Same with QQQ, right? Like if they get added to QQQ, I mean, MicroStrategy right now is ranked like 120th on QQQ, which is largest global NASDAQ listed company. So right. I think it's the same concept there. I don't know if the bear market goes much lower than that value here. But again, if you think about same concept with MicroStrategy as with Bitcoin, people are going to invest in the S&P 500
right.
forever.
Right.
Any new dollars coming to the S&P 500 are going to be buying any equity in the S&P 500. Same with QQQ. And I think the design of the stock market and those assets, S&P 500 and QQQ, those are going to be around for at least a decade. Probably 20 years, probably 30 years. And I think it's so fundamentally entrenched into the design of the entire financial ecosystem that it's going to take a long time before people stop investing in the S&P 500 or the QQQ. And that happens even if Bitcoin's in a bear market, right? Like those investors that are buying those assets don't give a shit about Bitcoin yet, and maybe they will in the future, but they don't care. And so that's, again, price-agnostic buyers that are buying at any price that's going to be non-correlated to the Bitcoin price. And people need to think about that. So, like, if you think you're going to time this thing, sell at the peak, miss the peak by 50%, buy in the bear, never buy the bear because it doesn't go low enough because they've got passive support, you just completely miss this trade by years, you know? That's why I think it's pretty insane. Anybody trying to trade this, I think, is pretty insane. But hey, there's going to be people out there.
Yeah, and do you mind if I hop in here? And it's probably for the best that we're on this screen. One of the kind of simple-minded lessons that I learned, let's say, pretty early on in my investing career is that, you know, markets are way deeper than one's like initial perception, and this could be applied to a lot of things, whether it's like technical analysis or just one's general interpretation of or understanding of where asset prices are and where they quote unquote should be. And I'll have to go back and find this tweet for the historical record, but I remember going back and forth with my absolute boy Mark Harvey about MSTR in November of 2022, and like, believe it or not, my main concern was like, hey, you know, why didn't MicroStrategy's price, and you can see it here as we just break to the right of the green zone there, why didn't that level have that point in time have a higher MicroStrategy price than in February of 2021? And it was that like anti-correlation that almost like stopped me from like wanting to buy this stock. And before I go into what I've learned from that, let me just pause here and kind of like justify that way of thinking, because think about in November of 2022, shortly after FTX collapsed. If someone has...
That was 23, wasn't it?
22. November of 2022 is when FTX collapsed. If someone had a bullish view on risk assets at that point, right, especially Bitcoin-related risk assets, they're going to look back at the past 5 years and kind of see how everything performed against everything else. And certain, assets, what I might call like the junk, whether it be Zoom or DocuSign or Peloton or the Bitcoin mining stock guy is going to kill me on this, but I mean Riot blockchain peaked in February of 2021, right? And then did not have a higher peak in November of 2021 where everything else did. And that's that Riot blockchain, Zoom, Peloton, all these other sorts of like the COVID work from home type stocks. And to me that was a big red flag, because the thing about being a Bitcoin related investor is that the bar is considerably high, right? And I just recently, before we started recording today, I just recently saw a breakdown of like the top hedge funds, the top of like the biggest well-known hedge funds. And like the best one is like up like 20% on the year, and there's some that are like negative, and then there's some that are up 5, 6, 10, 12% to stuff. And it's like, these people, not only do those hedge funds have a low bar with the S&P 500 being their like, determining line of success or failure, but they even like underperform that, right? But as a Bitcoin related investor, if you're putting money to work like outside of Bitcoin, the kind of obvious school of thought there is that one would think that this instrument is going to actually outperform Bitcoin. So that the floor is much higher as a Bitcoin investor if your benchmark is Bitcoin versus like a TradFi investor where your benchmark is the S&P, even though most of these hedge funds like underperform the S&P, but that's another story for another day. But again, in that moment, November 2022, I'm looking at this stuff, and again, ARK's Cathie Wood, she peaked February 2021, and to me, I was putting that kind of like in the junk category. Whereas the things that had their peak in November of 2021 were all the best winners. Nvidia, Bitcoin, Tesla, even things like Apple, Microsoft, like the Mag 7 type companies that we talk about nowadays. They all peaked higher in November than they did in February. So the whole point of that, and that was like a longer ramble than I wanted to put into words, but that way of thinking was something I was like seriously thinking about in November of 2022. The thing that I've learned since then is that like higher dimension thinking would have been very helpful in that moment, right? I hadn't even heard of the S&P 600. I haven't heard of the S&P 600 since March of this year when Punter Jeff talked about it in I think it was another solo video. That's when I was like, oh, I didn't even know the S&P 600 existed. So like higher dimension thinking and understanding those, mechanisms of change from ETFs and index funds going from either holding or not holding the asset is something that should be at least somewhat baked into my thinking, and we can't just look at this like price statistical thing and make decisions off that in a vacuum. So that was like a big lesson learned. I love this chart, the mNAV on a time series with the MicroStrategy chart behind it. But again, thank you for that, honestly, Jeff, because like, you gotta learn from your own mistakes, and like that was an overly simplistic idea I had. Luckily, I still went in big on the stock, and now here we are. But that could have been a massive point of regret for me had I just disregarded it.
Yeah, I think it's super helpful to just know that passive funds exist, right? Like going back to Quant Bros episode 2, right? Like, and thinking about crowded trades. Every trade in the entire market is crowded. Like it's being held 100% by somebody at some point in time. It might be more market makers, it might be more passive funds, and having an understanding of like the scale of every single equity relative to each other and how much passive funds sit in those types of equities and their potential trajectory. So you think of like, okay, if passive is going to squeeze each of these equities even more, the amount of available trading shares that are trading at the margin just continues to get smaller and smaller over time. And it's fundamental. It's on every single equity in the entire stock market. And it's like this base layer of support where you've got the Russell, you've got the S&P, you've got QQQ, and there are some equities that just kind of get pushed higher because they fit into all of these category thresholds, and they're trending appropriately, or they're trending in a certain direction. And luckily with Bitcoin, you've got the trend in the up and to the right, so
right.
Which helps. But anyway, this visual here, I think this is the exact same data from the prior visual. However, it's shown in a little bit of a different way, and I actually really like this one a lot as well. So this is showing the multiple on net asset value as a time series over time, as opposed to relative to Bitcoin price, right? Like the last graph was the multiple on net asset value relative to Bitcoin, and this is on a time series, a linear time series. So all the same categories, right? But I've just chopped it up into blocks here. In the first category, you've got trailing 12 months earnings positive, basically included in the S&P 600. This next box, the first large negative earnings report in the dated accounting rules and negative trailing 12 months earnings. And you can see here, so the price of MicroStrategy is faint. It's this blue line that's kind of going behind the scenes here. And the orange line is the multiple on net asset value over time. And you can see that the price of MicroStrategy, when it was at its highest multiple on net asset value, the price of MicroStrategy was actually incredibly low. And going into the second category, having negative earnings and negative trailing 12 months earnings, as soon as the equity went into negative trailing 12 months earnings, everybody that was holding the stock that had any algorithms that knew that they were going to fall out of the S&P 600 probably sold it. Despite the price of Bitcoin going up, because they knew that they're going to fall out of the S&P 600. Again, we think the whole world knows about Bitcoin, but they don't. There are so many algorithms that are built for all of these equities in the S&P 600 or all of these equities in these other indices, and it's algo trading that's happening behind the scenes. So it's interesting you see here that the multiple on net asset value falls kind of drastically despite the price of Bitcoin going up, again, because the earnings per share was falling. After they had their Q1 earnings report, which is like negative $11, like wiped out all of the earnings, they clearly no longer qualified for the S&P 600. It was incredibly clear. At that point, the multiple on net asset value, again, fell even further. Once they were removed from the S&P 600, you can see, and this is kind of to Ryan's point, MicroStrategy didn't have a second peak when Bitcoin had its second peak. And the reason being is because there were 570,000 shares of MicroStrategy that were sold on the market, and they no longer had that base support of that passive index that were kind of holding them up. Had they stayed in the S&P 600 and earnings were treated how they are with FASB in 2025, we would have seen a second peak for the price of MicroStrategy in November of 2021 when Bitcoin had its second peak. However, obviously we can't go back and retest it, right? But I think based on looking at it this way, it's pretty clear. So this happens over time. You can see the price of MicroStrategy falls. mNAV stays pretty much flat. And then you have sailors selling shares plus the Bitcoin ETF. So the Bitcoin ETF is approved. Everybody sells their MicroStrategy to buy the Bitcoin ETF, like silly people. I got a tweet on this, like the kick yourself in the dick trade. Like you sell the thing, to buy the thing that makes MicroStrategy even more valuable. So it's just, it's kind of and you take a taxable event. It's just kind of a silly trade. And when it's effectively the same thing. So anyway, the price of MicroStrategy continued to rip despite sailors selling shares, as the price of Bitcoin just continued to go higher with people buying the Bitcoin ETF. The last component is MicroStrategy added to MSCI. Again, NAV is relatively similar here. I think there's really some choppiness. I don't think there's particularly any new people buying MicroStrategy at the moment. I think in order to see the net asset value jump again, we probably need a couple of things. One, the price of Bitcoin to gap up. I think if the price of Bitcoin gaps up, it will be in the news. People will be buying MicroStrategy, and people might make the reverse trade, selling the ETF to go to MicroStrategy. And then again, you've got QQQ, which is the NASDAQ 100. QQQ, the NASDAQ 100, is the top 100 NASDAQ-listed global companies. It's not U.S. focused. It is global companies. There is not an earnings threshold that is required in order to qualify for QQQ. So if you go watch, Quant 6.5, I look at Tesla back in 2013. They didn't have positive earnings at the time, and they were added to QQQ in 2013, but they were not added to S&P 500 until, what was it, around November 2020?
Of 2020, yeah.
Yeah, November or December of 2020.
December, I think it was, of 20, yeah.
Yeah, December of 2020. So there was a pretty big amount of time between going from QQQ to S&P 500 for Tesla. However, with the adoption of FASB and the restatement of financial accounting and the getting credit for their digital assets at fair value, that will erase all of the negative earnings historically and have a single earnings period with materially large earnings per share, which would qualify them for the S&P 500 as well. I think that will probably happen Q2 2025, if I were a guessing man. So they've got to come out with Q1 earnings. It's going to be incredibly positive. When they have to adopt FASB, I think they're going to wait as long as they can to get as much Bitcoin price appreciation as possible. And then I think Q2, I wouldn't expect the S&P to approve them right away just by having like a one-time increase in earnings per share. I think maybe it's Q3. They might want to see it happen over time. So something to be aware of. But I mean, they're like the 301st largest equity in the stock U.S. stock market right now. So they certainly qualify from a market cap perspective, a liquidity perspective. Every other box is hit with the exception of earnings. That's why I post about it every day, because it's pretty exciting.
Yeah, and if you don't mind, just to comment on a few things here, I think that summed together concept is just so importantly crucial, and I've seen we've found ourselves saying summed together in the comments like over a multitude of tweets over the past several months, and like what that essentially says is that it doesn't matter what happened 2 or 3 quarters ago. You can sum them all together on one quarter, and assuming it's a positive number, and with our situation here with MicroStrategy, assuming the FASB fair value number is materially higher, there should be obviously no issue in meeting that threshold of the past 4 being summed together, even if the previous ones were negative and Q1 was by $8.50. So that's the first piece there. And then if we can just go back to the other this chart here for a second, and then I'm happy to go back to that data table. But before I forget, I think that the volatility of the multiple of net asset value and the volatility of the price is something that's like interesting and worth talking about. So if you wanted to move the mouse into the purple zone at the lows, off the top of my head, I feel like the absolute lows there for the stock price was 450. And I know that some of those dots right where the mouse is are below the 1 on multiple of net asset value, only by like a little bit. But I remember posting back at Doc being like, we're already at the discount now. The stock seems very cheap here anyway.
I think that's when Preston Pish bought.
Sure, I mean, hey, good.
That's what he was talking about. He's like, I will only buy MicroStrategy if it's worth less than the amount of Bitcoin they hold. And I was like, wow.
I think that kind of goes back to the point I was saying where like there should be a value, and I'll get back to this, but there should be a value placed on MSTR's like capital markets activity, right? Because an ETF will never be able to do that. You or me cannot borrow nearly as much money at that generous of an interest rate. It's like it's only a public operating company that can do that. So with that being said, there should be a value placed on that above the Bitcoin holdings, right? Unless people are just super doomers saying that, you know, nation states are going to collapse and like equity markets are going to collapse, like unless they're taking that like extreme ideological view, which like I don't agree with, but like I at least understand. But in the TradFi or just finance Bitcoin people, shouldn't there be an understanding? And I know Bill Miller's tweeted about this because I've retweeted it. Like people who understand like cost of capital and corporate financing would of course think like the value would be above like 1x of what the Bitcoin's worth.
Yeah.
You know?
Yeah. Yeah, it's a... I think people are certainly... There are going to be people that sell at a certain multiple of net asset value and then flip and buy Bitcoin, which, I mean, good for them. I think that if you didn't feel comfortable with your Bitcoin stash relative to how much Bitcoin you have relative to the rest of the humans on the planet, I think that makes sense.
Right.
But if you felt comfortable with your Bitcoin stash in cold storage, knowing that you have more than like what the average human can have if they were split up evenly amongst all 8 billion people, like you're probably going to be okay even if MicroStrategy went to zero. So that's kind of one of the perspectives I take. It's like, okay, if I believe in Bitcoin and I believe in MicroStrategy, if MicroStrategy goes to zero, I want to have enough Bitcoin where I still have a lot relative to what the average person would have if they were split, if all 21 million coins were split evenly between 8 billion people, or even 300 million people, right? Just the United States. Like I want to feel wealthy relative to the rest of Americans, like whatever, right?
Strong.
So like that's one perspective you could take, and if you feel comfortable with that number, and from my perspective, I feel comfortable with that number. I have capital elsewhere, also in tax advantage accounts that are that are in MicroStrategy, and that's the way I look at it. That's not financial advice at all, but that's like my perspective on how to look at it. It is a de facto ETF. However, it's also an operating company with the potential to earn a yield on the best asset on the planet, and something that I've been learning over time as I continue to go on my Bitcoin education journey. Bitcoin is more than just a store of value. It is programmable money. You can write code on Bitcoin. You can write a piece of code that locks up Bitcoin for a decade. You can write a piece of code that creates this multi-sig configuration. You can write code that can create a multi-sig configuration and also create a insurance transaction, right? Like you can write code to have Bitcoin be stored in escrow by multiple entities at the same time. Like it's programmable money, and that is super underpriced. Nobody, like I don't think majority of people really understand how complex this thing is. And so I know a lot of people have asked, like, is it valuable to go to a Bitcoin conference? I think the value in going to a Bitcoin conference is realizing that this thing is way further ahead than people realize. And there are a bunch of nerds that are taking this thing to the next level. I know a lot of people go to like the keynotes, right? Like they went and saw Saylor talk about $49 million Bitcoin or go to Donald Trump. But I think there was an OpCat conversation that was happening at the same time as one of these, and that's like a really interesting component of like leveraging Bitcoin code. And there's a lot of really in-depth computer science conversations that are happening behind the scenes on Bitcoin that increase the value and the operability and the ability to, in the future, earn a yield on Bitcoin. Like MicroStrategy is going to be a Bitcoin bank over the next 20 years, almost guaranteed.
Yeah, I agree. Yeah,
they're going to be a bank that's offering people business loans to go generate revenue, right? Like that, like if somebody wants to go start a coffee shop and they think they got a good idea, like they're going to be offering business loans, and there's going to be underwriting, there's going to be probabilistic distributions and understanding profitability. Like this thing is going to keep going for the long run, and there are many things that can be built on it: side chain, second layer, third layer, etc. And it just takes energy. Like it takes people devoting time and energy to it, and I think there are many people out there, myself included, who are excited to take that step and working and spending their monetary energy and human capital on developing like the new financial ecosystem. So if you got a bunch of nerds that are super pumped about this, that are spending their energy towards it, and they're going to continue spending their energy towards it, I think that's an interesting cult to follow. So anyway, we're plowing through here, man. Holy moly.
Yeah, no, but hey, there's a lot of good stuff in there. I also missed the Bitcoin conference this year, and I mean that in the literal sense of like I wish I would have like been there just to like meet the people and see some of the like, on the ground, boots on the ground type innovation that's happening with, layer twos, or even something like Nostr, or something like, exchanges, or whatever it may be, just to see the infrastructure being built out. Also something like Cantor Fitzgerald, actually, with like, wanting to be a pioneer in the Bitcoin borrowing space. I think that's like a very attractive proposition, using Bitcoin as collateral for things of that nature. If I can just ask you, if we can just go back to the last chart, I just have one thing, and then I'm happy to keep pushing forward. But like 1 or 2 talking blocks ago, I was talking about the volatility of MicroStrategy's mNAV, which again is multiple of net asset value, versus the volatility of the share price. This was the point in which I had said, I think that like actually right now where the mouse is a little bit lower on the low point in the purple box. Yeah, right there. This was the point in which I was saying, MicroStrategy, I think like the low at that point was like $450 a share, and I know that the mNAV was at least 3 to 5% below 1x. It's like MicroStrategy was trading 3 to 5% below 1x multiple on net asset value, and I was sharing that with Doc to be like, hey, it's actually at a discount now, whereas he was kind of doing his whole doomer pitch on MSTR, and that was fun. But the point here that I'm trying to finally make here is MicroStrategy shares bottomed out where the mouse is now, $450. It went up to almost 2,000, literally 1 penny below 2,000 at $1,999.99. Whereas the multiple of net asset value basically went from like just a little below 1, but we can almost call that 1. It's almost like it went from like 97% up to like 210%. And same thing on the drawdown as well. If we look back to the left, back to the first move, the highest ever, mNAV was 6, and that's almost like not a fake data point, but it doesn't seem like it's like super relevant relative to the size of MSTR's market cap at that point, which was only the software business, which was very small, and also to the smallness of the amount of Bitcoin that MicroStrategy had at that point. So when we look at the actual peak in that Feb 2021 period, the stock hit like mid 1300s at the absolute high, right? And then the stock, as you go towards the FTX lows, I think like the absolute low, and this was in December, it wasn't even in November, it was in December, I think, from like tax loss harvesting. The absolute low, I believe, was $135. So that's, a 90% decrease in the share price versus if you look back at the February 2021 peak, the, multiple of net asset value is like 3.7 on that orange dot, and that only declined to 1. So like there's that whole block of me talking just now was to just stress like the reality that the share price is going to move in an excess of the volatility of the multiple of net asset value. And I think that's a good thing because it leaves this uncapped like right tail for like shareholder value creation without the multiple of net asset value even keeping pace with the relative level of, shareholder value creation that comes from the stock price going up,
Yeah. I think if you also go back and look at like Google search history of Michael Saylor or MicroStrategy, we're nowhere near the peak. And I think the peak of Michael Saylor and MicroStrategy was probably around here, or it might have been around here, actually, kind of the peak of Bitcoin in last epoch, November of 2021. So the relativity, we still have a lot of room to grow, I think. And then if there's, again, any passive investment, just going and looking at QQQ, right? If MicroStrategy was added at a rank of 50, they would have 0.42% allocation, which is that right? 1.1 billion of buy-side volume. That would represent 740,000 shares at today's share price. But if they're at the rank of 50, the share price would probably be about double. So it's only about, it's about 300,000 shares of MicroStrategy being purchased at the margin. And anybody buying the stock right now is effectively front-running the front-runners of QQQ. If you go back and look at Tesla, when they were added to QQQ, they were added in July of 2013. The price of Tesla started ripping higher in like April of 2013. So May, June, July, like 3 months prior to, so September, October, November. I would think like October, November, December, if the price of MicroStrategy is like within top 75 NASDAQ entities, I would suspect there's going to start to be a little bit of front running, recognizing that there's going to be QQQ inclusion on the horizon. And I don't think, I think big money has missed this. I think that's the other thing you got to think about is like, are you in before big money? I work in traditional finance, and I certainly think so. Just speaking to most of the people that I work with. But yeah, we'll see. We'll see how it goes. Should be exciting. Should be an exciting time. I mean, originally my thesis, I didn't expect MicroStrategy to really start go on a tear until like October. So anything that's happened between now and like January has just been gravy. So like anybody that's freaking out over like what's happening over the next couple of months, just sit on your hands and take a deep breath and go live your life for a couple of months, because I think the real craziness probably happens in Q4, like election and interest rates and all that jazz.
Yeah, rates going lower, that's big.
Yeah, it's just it'll be like a signal. Like we need a signal. We'll see how that goes. But anyway, shall we switch gears? Okay, switching gears. Thinking about one question that's come up a lot is stock split. MicroStrategy is going through a 10-to-1 stock split in August. which is coming up. I think that's definitely in a couple days. I think it officially occurs on the 1st, but doesn't get recorded until the 7th. I'm not exactly sure the logistics. I don't care.
Yeah.
Like I'm not. I don't think the price is adjusted until like the 7th or something like that. I don't really care about the logistics because it really just turns your shares into 1 share into 10 shares, etc., and 10 shares into 100 shares. And same with your options, which is nice and easy split. So if you hold options, like 1 option, I think now becomes 10 options, which is exciting stuff. Increases the liquidity of the options. It should be very interesting. From my perspective, the stock split increases the liquidity of the options market. Now you're going to have more retail investors that are playing in the options market, which in my opinion just introduces a little bit more chaos theory into any market maker that's trying to have to understand where the market is based on derivatives, because generally on most assets, I think the market market makers are some of the primary people that are investing in derivatives, and you got hedge funds and things that are investing in derivatives as well, but the derivatives market has a really big impact on how an equity may move. Anyway, some of the questions that come up are, what's the price going to do after a stock split, right? Obviously, it changes the nominal bias. So if MicroStrategy is trading at $1,600, it's now going to be trading at $160, which for whatever reason, nominal bias does play in to how people invest in stocks. I think most trading platforms these days have fractional shares. But if you're trying to orange pill somebody to buy MicroStrategy shares and they look at the price of MicroStrategy and it's $1,700, they may be a little bit turned off by it being expensive nominally, or that there's a lot of room for it to fall, right? Like if it goes from 1,700 down to 1,000, like that's painful. But if it goes from 170 down to 100, that's a little bit less painful optically. I think that's just how the human brain works, and can't conceptualize exponents, even though it's the same shit. So, nominal bias, retail plebs coming in the door, chaos theory in the options market, and we'll see how it goes. Now, looking at what the screen is showing is Tesla. This is 2 stock splits. I've had a little bit of back and forth with somebody on X about stock splits, and the comment was that stocks tend to underperform in the 12 months following a stock split. So I looked at a few options or a few examples to get some perspective on how some other stocks performed after stock splits. In my opinion, a stock split on a mega cap company, you have base effect math working against you, and I could see any of the top 5 equities ish, if there was a stock split, having some potential detrimental impact because of either trading at $3 trillion or $2 trillion. But I think the fundamental impact on lower market cap companies, like middle market cap, smaller market cap, can be materially higher, as a small number of new traders may make a big impact on how a share or how an equity is traded at the margin. So, looking back at Tesla, what happened to Tesla in 2020? They had a stock split in, I think it was like August or September, and the price over the next year went up 65%, and the price over the next 15 months went up 148%. Now, what do we know about 2020 and 2021? You could have thrown a dartboard at any single equity in the entire stock market, and you could have done well, regardless of whether a stock is doing a stock split or whatever. Everybody knew that as long as you weren't investing in like Royal Caribbean cruise lines and like travel business or hospitality, like you're gonna do well. And pretty much every single equity in the entire market, aside from hospitality and those other equities, did really well. Now, fast forward, Tesla also did another stock split in August or September of 2022. And if you look 12 months after that stock split in 2022, the price was down 18%. which, thinking about the bias of that comment, the federal funds rate went from zero, like money was free in the last stock split, and the federal funds rate at the time of split was like 250 basis points, so it was up, infinite percent from zero, and everybody knew that the Fed funds rate was going higher, and the cost of capital, like there was a hawkish view from the Fed, and the cost of capital was increasing drastically to kind of tame inflation. So if you go look at any equity over that same time period, I think the S&P 500 is down pretty drastically because there was this correction as the cost of capital and the Fed funds rate kind of went up drastically. If you look at historically too, I think this is the fastest increase in the Fed funds rate. Every single increase in the Fed funds rate was 50 bips. It was like 50 bips every month, 50 bips, 50 bips, 50 bips. And historically, the Fed has like stair-stepped their increases at 25 bips. So it was an incredibly fast increase. Not surprised at all that it throttled tech stocks. And if you take the perception that stock splits lead to deteriorated performance, you got to take into consideration the macro environment. What is going on in the macro environment? So the response I got was, go find a stock that had a 10-to-1 split. I think Tesla had 5-to-1 split, Ryan? 3-to-1 split, 5-to-1 split?
It was a couple different ones. I think most of them were fives of the two that we're looking at here.
Still big splits, right? Like it changes the nominal bias. So I went back and I found another stock that had a pretty big split. Tesla was a weird proxy because you had a couple other things going on, right? You had the S&P 500. A couple other things going on with Tesla at the time.
Cybertruck, Megapacks.
And they were also getting valued at like $600 billion, $700 billion. They went from $200 billion to $700 billion, and everybody's like, holy shit, this is going to be the number one pubco ever.
Yeah,
now,
I
went and found another company that did a pretty large stock split back in 2016. They did a 5-to-1 stock split, this Intercontinental Exchange. They were a $31.7 billion market cap in October of 2016. And over the next 12 months, they went from $31.7 billion to $39.2 billion. So they went up 24%, and they had a 1.17% dividend yield. Now, the stock didn't go up 200%. Yeah, you got me on that one. However, has anybody ever heard of Intercontinental Exchange?
Right.
This is not a household name. They own 0 Bitcoin. In the period of 2016, 2017, nobody knew about this company, and it wasn't on Twitter. This wasn't like an explosive stock by any means. However, it performed incredibly well after a stock split at a 5-to-1 basis. Granted, 2016, 2017, I think Trump was just elected in 2016, so a lot of stocks did well. I think 16 to 17, I think a lot of equities did really well, but they weren't increasing at the same pace as they were in the COVID years, 2021. That was pretty extraordinary with the increase in money supply.
Sure.
So the response I got to this was, you think those are good gains, 24%? And so it's like, that's fair. And wanted to look at any stock that had a 10-to-1 stock split. So I went a little bit further. I dug deeper because I think this stuff is interesting. And honestly, this data is kind of hard to find. But I went back and I looked at every single stock that did a stock split greater than 10-to-1, which there's not a ton. I'll tell you right now, there's not a ton. Between 2014 and 2024, so over the last decade, I identified every single public entity that has done greater than a 10-to-1 stock split that had a greater than $5 billion market cap, right? So I'm not taking into consideration the companies that were like 15 million in doing a 10,000 to 1 stock split, like that.
Penny stocks,
Yeah, I wasn't looking at penny stocks, and I had to kind of differentiate this. So a couple of things pointed out to me, right? There's 15 companies here, which is not very many. 15 companies have had greater than a 10 to 1 stock split in the last decade. Many of them, so if you look at any of them, number 1 through 9, any of the stock splits in 1 through 9, this is the date of the split. This is in a tight federal funds economic environment. So any stock split from 2022 to 2024, the macro environment is a 550 basis point federal funds rate. So if you look at the performance over the next 12 months, the stock market has kind of gone sideways in 22, 23, with the exception of Bitcoin correlated equities, and that there have been other couple poppy stocks, but a couple jumped out. Right, Shopify, they went up 92% in the 12 months following their stock split in 2022. This is a little bit of an anomaly because the price of the stock was at 90, and then right before a couple months before the stock split, it dropped to 30, and then 12 months after the stock split, it went to 60. I have no idea what it's trading at now. But it did a 10 for 1 stock split, and it's a $76 billion entity. Then you've got this other company, Jackson something, JXN, which is a $7 billion company. They did 104,960 for one. And over the next 12 months, they went up 19%. And then these two others here, again, CSGP, TTD. Most of these companies on this entire list, I've never heard of them.
Yeah.
Right? You've got Chipotle, Nvidia, U-Haul, Google, Shopify, Amazon, Levi's. Right?
The Trade Desk as well. I've at least heard of them. Yeah.
The Trade Desk, but it's not a sexy stock.
Yeah.
So that's when I tried to do analysis on this, and I was just sitting there thinking of who's investing in these stocks? Does the stock split matter? Is the stock split more of a board of directors, move or implication to make the stock go one way or increase liquidity for investors or employees or something like that? There are so many things going on with all of these companies that may lead to separate reasonings for doing a stock split. And looking at any of this data, if you look at the pure average 12-month increase of any of these stocks after a stock split greater than 10 to 1, the pure average is 8.9, the market cap weighted average is 8.4. If you're using the S&P 500 as your proxy, it's about the same. So I guess if you think you can make 25% return on any of these types of stocks, investing in this, I don't know. The concept is strange to me, to trade MicroStrategy at all, before the stock split, thinking that there's going to be less option activity and less upside because of the stock split. I think there's a significant number of people that are going to be excited about the stock split and buying at the stock split. There's going to be increased options activity. There may be less options volatility, but that just kind of depends on the scale that you're trading at, right? So, I don't know. I thought it was an interesting argument. I did some research. More analysis needs to be determined. You got to think about the macro environment in any one of these, right? Because the Fed funds rate over time has a really impact on cost of capital and opportunity cost, right? A lot of people were transitioning from tech stocks and high risk equities into low risk, government bonds, high yielding treasuries.
Sure, yeah.
And that's an easy trade as a bank or an insurance company to reallocate if you feel take money off the table and go invest in a 6% 2-year government bond. Easy trade. So, anyway.
Yeah. I mean, several things that I want to touch on. And by the way, great overview. We can probably stay on this one for now because I'll talk about this point first. But the first thing that's worthy of being said here is my my ongoing critique of the Doc Kruger way of thinking, as I called it, and I continue to call it, because I think Doc has this tendency of like looking at each individual variable or catalyst in such a binary way where it's either like this thing matters a lot, which for him, like that was like the US spot Bitcoin ETF. That was his thing that like mattered a lot. And other things did not matter, a la like an El Salvador, nation state adoption didn't really move the needle. And that idea carries over into this, Twitter back and forth here that you shared, because it's like, for me, the stock split is just one part of it, of a cake, like you said, the layer cake that has like so many more parts to it, or like the reflexive flywheel concept that we talk about, where it's not just about any one of the individual catalysts, it's about all of these things happening in a 12 to 24 month period, and the concept of reflexivity that is just so clear and apparent in things such as the market cap of MSTR at S&P inclusion is like proportional to the amount of shares that have to be bought. Like that's like a massively powerful thing, and it's working alongside of all these other catalysts, the Bitcoin cyclical seasonality catalyst, the switch to FASB fair value, which to my understanding is going to be the largest quarter over quarter or year over year increase in earnings per share in American history. We've got that working. small things. We've got that working for us. We've got of course there is the Bitcoin seasonality thing. We've got Michael Saylor as being receiving the largest amount of applause at Donald Trump's speech at the Bitcoin conference. We've got all of these things like working together at once, and the whole rest of the the reflexive flywheel catalyst. That my take on this would be such that we shouldn't just look at like, oh, the stock split itself. We should be evaluating all of these other things. And the big thing that I mentioned in that quick list of things that like add to MicroStrategy's value is, again, this capital markets activity where they can sell, convertible bonds in a way that's more accretive in terms of Bitcoin per share versus just selling shares at the money to acquire Bitcoin. So again, we combine all of these things together, and that's what I think the focus should be, not just any one individual thing, but the thing that does come from the stock split. And I've got one more point after this. The thing that actually does come from the stock split, because I think Jeff touched on this, like the fractional shares, the ability for retail investors to own fractional shares already exists. But I think the big like mechanistic change with the stock split is in the options, because the options prices will now be 10 times less than what they were, right? And of course there is this still like human psychology concept in that, like because the share price is what it is, more people are going to buy it, and whether that is true or not is like less relevant, because people will still front run that thing whether it like ends up being true or not. And then the third point there on the stock split is that it really is a bullish signal from management, like above all else, perhaps above like the options prices and above the human psychology of a lower share price. I think the most important thing that comes from a stock split is the bullish signal that gets sent from management, because executives don't split their stock unless they think it's going higher. That's that's what I've like seen to be true. But again, the biggest point here is that it's about the combination of catalysts. And then my last point, and it's for this screen right here, is that the 2020 and 2021 investing environment in which we both lived through and invested through was one for me that was like filled with fear the entire time because of the base effect math regarding interest rates. Like the hedge fund managers and the folks who were not like pounding the table at peak COVID, March of 2020, to sell bonds and get out of that trade forever is just beyond me, because the fear is that if the Fed funds rate and like the 1 month, 2 month, 1 year, 2 year treasury bond is at zero, the risk is not that it keeps trending lower or even goes negative. The risk is that it moves higher from here. And if it moves higher from here, then the outsized, like what we always talk about, base effect math, is going to be so huge in percent like change of recent years. So for me, 2021, I spent many sleepless nights like staring at the ceiling above me, questioning like, should I be like letting go of risk assets here, because like the effect of the Fed funds literally going from 13 basis points, which is 0.13%, up to 500 basis points, which is 5%. I mean, that move is just so extraordinary. And I was kind of concerned about like a Great Depression coming to fruition, like something that like Ray Dalio, the big philosophical thinkers on like the credit and like debt cycles. I was like, oh my gosh, like we like on this chart 2020, like we were at like the human unprecedented levels of low interest rates, not just American history but also like European history and like the world's leading empires that existed before America. We were at unprecedented human like low levels in interest rates. So again, the risk is the convexity to the upside of interest rates going higher. So I'll finish this up here. I say all of that to say that like that was like a serious period of fear for me, and perhaps like for others, just worried about the risk of like where interest rates can go. But now, fast forward to today, I don't think rates are going back towards zero, but I think that the general push of energy transferring through financial markets will be that of a quantitative easing, dare I say, of an easing of monetary conditions. So I don't go to sleep tonight anymore with that like risk of like, oh my gosh, the Fed funds rate is literally at zero. Any moves higher is going to be, massive in percent change terms. Now I think, when are rates going lower? And it looks like we have, 2 cuts on the table with the September cut, best to my knowledge. And I'll end up posting this in the show notes for clarity. But I think the September cut's like 99 or 100% baked in. And I'm of the belief that the market drives the Fed and not the other way around, meaning the Fed ends up just doing what the market already like told us it's going to do with the probabilities. And I'll end up bringing up that CME FedWatch site. I've shared it before several times. Remarkable tool. But that's my point there on interest rates.
Yeah, well, it's a great point. And I kind of want to simplify this for folks that may not speak the same language that we do. When you think about interest rates being at zero, right? Ryan, you talked about. I don't know why everybody didn't get out of bonds when interest rates went to zero. I just want to explain this. When interest rates go down, when interest rates are low, the price of a bond goes higher. So basically, it's much more near par. So basically, you put in $99, and at the end of the period, you may get 100. Now, when interest rates are high, you may put in $80, and at the end of the period, you may get 100. That's because the cost of capital, or the pegged cost of capital, or the risk-free rate. So the federal funds rate is the risk-free rate. So you can invest in government treasuries and get the federal funds rate, and that's risk-free, right? Because the federal government can print any more money, and you will always get your money at the end of the period. Any other corporate bond has to have some risk return on top of the risk-free yield. So when rates go to zero, corporate bonds were significantly lower too. Corporate bonds were trading at 4% or 5%, incredibly low, historically low. And now you have the risk-free rate of return increases drastically. So anybody that bought a bond, if you bought a bond for $99 expecting you get paid $100, and the interest rates flip on you, you can be underwater on your bond. And so this is a macro thing that happened in 2022. The bond market so the bond and equity market combined had its worst year historically since the Great Depression. So Ryan, your comments on the Great Depression are totally valid. And I saw this in the reinsurance market where, everybody's wondering why their insurance costs are going up. It's because insurance companies invest in bonds.
Right.
And bonds had the worst year ever in 2022, on top of having massive catastrophic hurricanes, wildfires, etc. And then you have, so basically all of these insurance companies that they lost a ton of money in the bond market because of the interest rate flips, and the equity market, it was down, and you had natural cat disasters. And so the entire market's got to recoup that capital somehow, and that increased insurance rates. So that's kind of what's going on in the macro capital environment, and thinking about the bond market and equity market, how it all kind of works together. Watching the federal funds rate is helpful in understanding capital markets.
Yeah, and just one more thing to tap in on this, for folks who aren't as acclimated with the impacts of interest rates, I would say interest rates going up are very much a double-edged sword from both the investor perspective and also the company perspective, because there's not necessarily a strong correlation between volatility and interest rates, but interest rates going up has an effect on companies, and I'll touch on that in a second. The first piece here is on the investor front, how increased interest rates will kind of influence investor behavior. Is that, if people are looking for equities that are going to, go up more than 7% per year to beat the increase in the M2 money supply, and also look for, equities that'll give them a 4% dividend yield, let's say, a la, this is kind of like the Bristol Myers or the Coca-Colas of the world, and it might be more closer to 3% dividend yield, but that kind of general ballpark, they can sidestep the equity risk completely and just lock in, risk-free, returns with bonds. And of course I put that in air quotes because nothing is risk-free, and the difference between 99.99% risk-free and 100% risk-free is greater than the difference between 0 and 99% in the first place. So thinking in those absolute terms, I think, is mistaken at first, but the general concept there is from the investor perspective, right? If they can sidestep the equity risk completely, and the equity risk also extends to risk assets such as things like, Bitcoin, Tesla, Nvidia, things that don't even pay dividends. But if the investor can sidestep that risk completely and lock in their mandate of their dividend yield by way of bonds, history shows that they typically will. So that's number one, and a lot of that stuff touches on what Jeff just said from the investor perspective. But then number two, on the company side, it really limits like how companies can grow when the cost of capital goes higher in a number of different ways in and of itself. Number one, the big firms, the Apple, Microsoft, Amazons of the world, it really limits their ability to do share buybacks because the cost of capital has now gone higher. For big and medium and small companies, it becomes harder to have a higher payroll, like to pay more employees to work for the company. So sometimes like layoffs have to happen in that scenario. It becomes more difficult for a company to fund their capital expenditures, right? Like Tesla's a good example of this. Like building a new factory becomes materially more difficult when the Fed funds rate is at 5% versus when it's at nothing. You know what I mean? So there's this double-edged sword, and that's really the main like takeaway here from my interest rate ramble, is that there's a double-edged sword of the risk of interest rates going higher, both on the investor perspective and also the company, the relevant company perspective. And I think that stuff has a driving force throughout all risk assets and even Bitcoin, because the correlation sure has straightened up to be pretty strong between the SPX and Bitcoin. And I don't want to pivot the conversation here by any means, or bring up something that goes against the ideology of this being a non-correlated asset, but I think Bitcoin can still end up trading in the direction that like the overall economy and the overall business operating process ends up going. So in order to facilitate that, I think like lower interest rates would be better, of course.
Yeah, it's a complex equation. I think that they will probably trade correlated for maybe one or two more epochs. And I think there will be a break in correlation at some point when there's going to be that opportunity cost. Like all capital has opportunity costs at all times, everywhere in the world. So everybody is trying to find the best yield for the best amount of time period for the best purpose, or for whatever their time horizon is. And yeah, it's an interesting for those that are listening on. I've got on the screen now the federal funds effective rate over time, so you can go back and look at this. Like, it's interesting data to go look from like 1955 to today, and look at federal funds rate and see how interest rates have changed over time. Any of those of you who maybe have parents or something that bought homes, or any of the folks bought homes in the 80s, you may have had a 20% interest rate on your home, and it's likely a function of what the Fed funds rate was at the time period. Also, what a really challenging time to live, right? Like interest rates being incredibly high, it just changes the whole way your economic society would function. Can you imagine trying to buy a car with like a 17% interest rate? It would incentivize anybody to hold cash, because the value of your cash goes really far. Because if the price of like car loans were going at 17.5%, the price of the cars would be incredibly low, right? Like nobody would buy a car because they couldn't afford the payments. But if you had a lot of cash, you may be able to pay a car and not have to get a loan. So anyway, interest rates are really interesting. I encourage anybody to kind of take a peek at these. It's pretty fun. Okay, I think I might stop sharing my screen. What do you think, Ryan? Do we keep cooking?
Yeah, do you want to pivot to the founder-led stuff on my side?
Yeah, absolutely.
One of the other topics that we want to talk about is what I would consider to be the most likely candidates for continued global adoption of Bitcoin for global public companies. And the thing that stands out to me so clearly is that these are all founder-led companies, right? We can run through the list of, MicroStrategy, of course, the career CEO and now executive chairman Michael Saylor is still at the helm. The Semler Scientific, a company in which I've now found myself studying quite a bit recently, led by a founder. The speculation around Michael Dell, who's also, a technology company founder. I don't know enough to speak about Metaplanet. I wish I did, but I hope that we're going to have, Dylan LeClaire on soon to kind of break down some of that stuff. But the general concept here, the point I'm trying to convey is that between both the, ability to operate under the perception of the founder and the corporate governance package that usually comes along with these things, i.e. a Michael Saylor at MicroStrategy having the controlling voting interest in the company, allowed him to move unilaterally in a way that a company like McDonald's or Johnson & Johnson can probably not move, now that those companies operate with a CEO and chairman that's 10 or 20 CEOs and chairmen removed from the founding company. So between those concepts and just the general idea that like the founder's not going to want to see his or her company die. So between that like overarching concept, the corporate governance, and just the ability for CEO, founder, chairman types to move with little friction, makes me think that these would be the most likely candidates to adopt Bitcoin. So looking at our data table here, ranked in terms of market cap from biggest to smallest, we've got we've got Nvidia, Amazon, and Meta. And the interesting thing here is that, Max Kaiser recently like tweeted a picture from Nvidia. Like we'll see what happens with that. Amazon, I don't think Bezos has really ever taken a position, but Meta, I think, is an interesting one in the sense that Mark Zuckerberg is, to my knowledge, like the only Mag 7 CEO who owns Bitcoin other than whatever Elon Musk still has or doesn't have. But I mean, this guy, like Zuckerberg, like named one of his goats like Bitcoin or something like that. So I think he's
Satoshi. Wasn't it Satoshi or something?
It was something like that, like a direct reference to Bitcoin. And I don't think they'll end up emulating the MicroStrategy like playbook or even adding any Bitcoin to the balance sheet, because they recently just started paying a dividend and started doing buybacks. And that's one of my notes over here that I have to look into for the buybacks, like relative to cash, and I have to keep like building this part out. But anyway, continuing to work back down, we come to Tesla. Maybe you've heard of it. Maybe you've heard me gripe about it in recent memory, but there was a fumbling of the bag here. You know what I mean? And I think one of Elon's biggest strengths is that he moves quickly, but I also think one of his biggest flaws is that he moves too quickly, in the sense that he just out of nowhere flipped positive on Bitcoin, and then within several months was selling some to test the liquidity of the market, and then several months after that was like selling even more Bitcoin. So there's some kind of like disconnect. There's many questions that have not been answered, but Tesla does have some Bitcoin, but very small relative to their market cap.
They have 10,000, right?
Something I think like 9,700, but yeah, just below 10,000.
All right, so you game theory that out, right? Like you've got MicroStrategy at number one. You've got, I think Mara is number two, like 17,000 or something like that. You've got Tesla is like the third largest with 10,000. He's already made a move. He clearly has gotten in trouble for like trying to move his stock from what he says. And now that there's a Bitcoin correlation, I wouldn't be surprised, again, if he is purposefully not saying anything. So, all right, so you got Tesla's number 4 there, right? Number 4. They've got 11,509. So, maybe I don't think he has to move at all, right? Like he can, unless Facebook came out and said, hey, we're going to buy 30,000 or so. If it looks like somebody's going to whoop his ass aside from MicroStrategy, I think he might change his tune, but he doesn't have to do anything right now, right? They got more than Coinbase.
Yeah, that is nuts.
Like
Coinbase is like 8,000, right? Yeah, just over 9,000.
So, he's got his position. They've made their position. I think they did have to sell some because they had a liquidity crunch with like trying to create one of their factories. And I think with the interest rate environment, they're like, shit, we can't borrow dollars at zero anymore. Like, we've got 15,000 Bitcoin. Let's sell 5,000 Bitcoin and build this, factory so we can get a better valuation. Yeah, I don't know. I try not to shit on Elon because he's probably 40 steps ahead,
Right.
And fumbled the bag, sure. Would it be an ideal world if they bought 20,000 or 40,000? Yeah, everybody would be jacked. But it's also probably fine.
Yeah, I mean, there's so many things I could say on this point, and I keep coming back to this point from Walter Isaacson, where I've tweeted about this already, but I forget if I was listening to the audiobook or if Walter Isaacson said this on the Lex Fridman podcast, but he said, Elon wants the world to be saved, but he also wants to be the one doing the saving. You know what I mean? So there's almost kind of like a real hero complex at play here. But there's also like the indecisiveness and wishy-washiness of Elon. Here's an example for you. He made he went to go clear his mind with Larry Ellison in Hawaii, the founder, chairman of Oracle. He went to go clear his mind in Hawaii. Ends up, tweeting the current CEO of Twitter at that time, who was like Parag Agrawal. I might have mispronounced the name there, but he was the CEO after Jack Dorsey, Parag. And Elon's tweeting or texting him saying like, what have you done this week? And like, I'm going to make an offer to, buy Twitter. And then 2 weeks later, or even maybe 1 week later, Elon tried to like get out of the Twitter deal. You know what I mean? So it's like, there's a real like pattern here of him flipping into something perhaps too enthusiastically and then like trying to like go the other way completely. So of course I'm not trying to be critical of like, the world's richest man or like someone who's like way smarter than me, but it's like, hey, there's a case to be made here of like being wishy-washy on decisions and flipping back and forth.
Yeah. No, I hear you. I wonder Tesla cash on hand.
It's all-time highs. It should be just over $30 billion, and it's the highest cash Tesla's ever had.
Yeah, so they got $30 billion cash on hand. And what's the value of their Bitcoin holdings? You just had it up.
It's here's the screen. It's Tesla, 336 million.
10%. 1%.
Wait.
3 billion. 1%. All right, that's not right. Is that right?
The market, it should
that's
be
entry value. That's entry value.
Today's value is about 1%.
761, about 2%. Divided by 30.
Well, the market cap of Tesla should be like 700-800%, or 700-800 billion.
Well, I'm not going off of market cap because market cap is synthetic. So like I don't really care about market cap.
Market cap is synthetic.
It is. Like so, their value of their Bitcoin, 761 million relative to 30 billion. So it's about 2.5%. So it's a diversified play. And if you think about a capital allocator, like nobody like there's no downside. Would it be better at 8? Yeah, probably. What's the most appropriate? What's the efficient frontier of like allocating your capital? And I mean, maybe he's got plans to utilize that cash here in the near future. I mean, who knows what the economic environment looks like in the next 12 months, but he's probably got a vision for that, I would assume.
Well, I mean, here's the thing, right? I'm mostly just venting about my, like I told you, I've got a post coming out tomorrow about all my gripes, like, with Tesla, and, like, this is a repeated pattern, you know what I mean? He just sent out a poll tweet the other day saying, like, should Tesla invest $5 billion into XAI? It's like, what about the money Tesla invested into Solar City, which is an entity that, like, most current Tesla shareholders have never even heard of? And now, fast forward to today, the solar line, like the line item of solar, has been removed from shareholder decks. So, I mean, there's just this complete, like, wishy-washy on things and stuff like that. So I'm, again, also, like, not trying to be critical and, like, you know, stay constructive and cheerful. But I mean, hey, there's also an evidence that kind of supports my thesis here.
Yeah. Just one more. I'm just going to push you on that a little bit.
Yeah,
Which I think is kind of fun. What if you weren't on X and you had no idea what Elon was doing, but you took a 10-year view on Tesla? Would you rather own it or not own it?
Well, I mean, interesting question, and I've always had a forever view on this, right? Between, like, this is the vertically integrated, like, hardware and software, like, dominant tech asset of our life, outside of Bitcoin, of course, where, like, the vertical integration piece is so crucial because all of the superchargers, all of the public charging infrastructure that matters, it's all Tesla. Dealerships, like where people go to buy the cars at like Ford and GM and Toyota, that's not Ford and GM and Toyota. Those are all third-party dealerships, right? The other auto companies, they don't have like elements to their business such as insurance and also making semi-trucks, right? Like that's so unconventional of the normal auto companies. Plus the lithium refining that goes on in Corpus Christi, the mega packs, which I'm like, you know, massively bullish on, and it's all of these things combined, and the vertical integration throughout, where there's no other like company involved. It's all Tesla. So yeah, I mean, for something like that, especially a company that has the ability to like mine Bitcoin themselves and all the hardware and software needed between computers they can obviously get through NVIDIA, solar panels on the Giga Austin factory to like receive the energy, mega packs to store the energy, auto bidder software, which is one of my favorite aspects of Tesla, the auto bidder software, which just trades the electricity back and forth between the grid as opportunistically as it can be. So it's like they have all the pieces in place and like really fumbled the bag in terms of his like, you know, wishy-washiness. So to bring it back to your question, it's like, what would my thoughts be? I still would have noticed the thing in the solar line item that got removed, because that was one of my favorite things about Tesla, is that it completes the home energy system between the power wall, which is like a mega pack for your house, the solar panels, and the Tesla car in the garage. Between those three pieces, all vertically integrated through Tesla, it completes the system. But now Solar City is like off the table, you know?
Yeah, it's an interesting one. Certainly,
it is.
Yeah, I mean, he's been directionally correct for the last 15 years, and I think he's probably going to be directionally correct for the next 15 years. I wouldn't bet against him.
Yeah, no, I mean, I'm not, I still own the stock. You know what I mean? I absolutely wouldn't bet against him, and. It doesn't take a genius to be like, wow, you did self-landing rockets. Like, you're incredible. Like, you know what I mean? Like, that's that almost goes without saying at this point.
True.
But if we elevate him or anyone to this like untouchable platform, then like what are we doing as analysts? By the way, and perhaps my last thing on this, although I think this will come up again in the future, is that like this is the guy who in 2017 was actively saying like, I don't comment on politics, I just want to like stay focused on engineering. Now that sounds crazy, doesn't it? Now fast forward to today, he tweets about politics every day. It's like these things have clearly changed, and there's like a lot of things that have changed along the way, you know.
Yeah, it's a good point. Well, let's get into some of these other ones. We got like BlackRock here.
Yeah, no, and we're going to end up coming back to the Tesla thing. That was a fun exchange, but we're going to end up coming back to that. But to finish out this slide in the next one, kind of what I did here on this data table is like the ones in blue I think are like noteworthy and interesting. Of course, we just talked about Tesla. BlackRock, Larry Fink, maybe you've heard of him. He's super bullish on Bitcoin. Sorry, I got the coughs. He's super bullish on Bitcoin, so one could imagine a scenario in which he'd want to have like some allocation of Bitcoin on the balance sheet instead of just holding cash. Or maybe
they're also generating fee revenue off of their Bitcoin though, so maybe not. I think that's like working for a company and getting paid in that company's stock at the same time. It's like, you know, right. pretty allocated here. I don't know.
No, I hear you on that, and it's almost funny that that BlackRock comes up on this list, because when you think of like value type companies, you think of non-founder led companies, and like BlackRock is a value, you know, financial services stock. It's a value stock, and yet they're still being led by their founder, and they already do have a ton of Bitcoin exposure. To your point about the fees. But one could perhaps imagine a scenario in which they wanted to hold even just like 1% of their cash or their, you know, liquid assets in Bitcoin, or even like the IBIT ETF. True. You know?
True.
So that's the second one. And then we keep working our way down here. We get to Mercado Libre, which I forget which country Mercado's in. I believe it's Brazil. But the reason I highlighted them, and I'll bring this other data table back up, is because
Uruguay.
They own Bitcoin. So yeah, here's Mercado Libre. I don't recognize which flag that is right there. Uruguay. That's awesome, man. So yeah, my understanding of Mercado Libre is they're essentially like the Amazon of that region in terms of shipping like consumer goods, and they have, you know, 412 Bitcoin on the balance sheet, which again I think speaks to like the global nature here of what we're talking about. Like this isn't just like something that Mag 7 type like relevant US equities have to be thinking of. It's like it's also the global equities.
I love it. I mean, if they bought 400, I mean they're going to buy more. So they've got $5 billion in cash on hand. 5.7 billion cash on hand.
And that kind of stuff doesn't even count like what we're going to talk about here in a minute with like, you know, leveraging the volatility of one stock to, you know, sell convertible bonds instead of just selling shares at the money to buy Bitcoin at the current spot price.
But they also have cash, right? There's three things you could do. You could buy with cash, you could sell your shares to generate cash to buy Bitcoin, or you can raise debt via convertible debt and a future promise on future shares for cash to buy Bitcoin. So it's like that's like the 1, 2, 3 way you can go about it. But like this company is $7 billion in cash on hand. They can buy hundreds, thousands.
I mean, all that stuff you said right there works, of course. Like companies can buy Bitcoin with cash. I think the more, or perhaps like the most efficient way would be to either like borrow against the cash, meaning hold cash but take on debt in some form and kind of back it so that you know you won't create a solvency issue.
True.
Or sell convertible bonds and try and like, you know, stack Bitcoin at a more accretive rate than you know, just buying it with cash. Because buying it with cash is great in the sense that like it very much simplifies the process, and there's no debt and all these other things for like shareholders to be concerned about. But perhaps it's not the most efficient way in terms of like utilizing some method of borrowing, whether it be like traditional debt or, you know, unsecured convertible notes, to buy Bitcoin at like a better rate of accretion in terms of Bitcoin per share rather than just buying cash. Like I would just always tilt towards the sides of like borrow, keep the cash, or keep the cash in some type of like return asset such as treasury bills, and then borrow to buy the Bitcoin.
Yeah, you use your cash as collateral as opposed to your Bitcoin as collateral. Yeah, it's smart. That's just a prudent business decision. Yeah.
Yeah, so there's that. Pioneer Natural Resources. I highlighted this because this is something me and you have talked about offline, and I'm sure we'll talk about it more again in the future. But like energy companies having an allocation towards Bitcoin can very much come by way of mining, with energy companies just using their excess energy, or perhaps finding a way of generating a higher return on their energy produced by using it to mine Bitcoin. I think there's a ton of potential development in that space, and it kind of shocks me that, you know, ExxonMobil, Chevron, ConocoPhillips, Occidental Petroleum, which is basically owned by Buffett now, so I see why Occidental doesn't do it, but the other, you know, major $300-400 billion oil companies, I'm kind of shocked that they aren't doing this more, like using their excess energy to mine Bitcoin, preferably for a HODL strategy, of course. But even if they were just selling the Bitcoin at the market on like a 6 or 12 month delay, like I would think that would have like more like shareholder value creation than however they're expending their excess energy today, you know.
So are the oil producers burning their oil though?
Well, that's a great question, and this is where I return to like not being an energy expert. To your point, they probably just want to sell the energy and not be involved with, and because there's also several steps involved with oil or natural gas involving like refinery phases and things like that, and it kind of gets, you know, passed down person to person or company to company as far as like transferring the energy in whatever state it is. So I get it that they'd want to be like only net sellers and not have to worry about like actually utilizing the energy. But from my understanding of like energy production, there's always some percent that gets lost. So if they could transfer that like somehow lost energy, even if it requires some upfront costs in terms of buying GPUs from NVIDIA or buying solar panels or buying a mega pack from Tesla to build up their like hardware infrastructure to mine, I think over the long run, that could be like a good area of shareholder value creation. Plus, and you and I talked about this, I think on the phone yesterday, about this could be a great way for traditional energy companies to hedge their bets against EVs, right? I mean, the combination of consumer like sedans of like Tesla EVs plus semi-trucks being, you know, EV powered and operated, that is going to have like a net negative long-term effect on the earnings potential of ExxonMobil and Chevron. So by them, you know, pivoting into something like, you know, generating Bitcoin, it could be like a phenomenal hedge to their business, which by the way already is very anti-correlated against the overall market. Like this is something I don't think it's talked about enough. there's 11 sectors in the S&P 500, right? Like technology, energy, financials, consumer discretionary, real estate, blah, blah, blah. There's 11 of them. All of them, except the XLE, except energy, move in one direction, meaning the correlation is very strong against all 10 of the S&P 500 sectors except energy, which is incredibly value. A la 2022, the trade of my lifetime that I missed was not, loading the boat on like ExxonMobil calls in like September, October of 2020, when Zoom Video had passed, ExxonMobil in market cap. I mean, it was nuts, and it reversed shortly after that. But yeah, the trade that I missed there was being long energy, and that was the only thing that worked while everything else was selling off. So that anti-correlation piece could have provided like more cash to buy more MicroStrategy or Bitcoin or even Tesla or something like that. So since the major energy companies, Exxon and Chevron, move in an anti-correlated fashion to the S&P 500, which is good, by the way, if they combine that with like a Bitcoin, risk asset correlation, and they get the best of both worlds, I mean, I think that could be like extraordinary for them.
Whoa.
Yeah.
That's I mean, that's a pretty profound nugget. 2 hours into this thing, thinking about the energy market in correlation to S&P 500 in trading energy. Yeah, they're really.
I mean, it's big, and these are monster companies who have even perhaps better financing opportunities than like a MicroStrategy, because they're more than 10 times bigger. So it's like
$300 billion companies. And that's a topic we can go through in this next in the next episode, is talk about some of these oil companies over time. Like, oil used to be the most valuable commodity.
Yeah.
And all of these oil companies used to be the number one ranked oil companies number one companies by market cap, until data became more valuable than oil. And then it's like all of these tech companies become more valuable than all these oil companies. Oil companies are still sticking around because oil is still important. And now I can see a future where you have Bitcoin companies, or Bitcoin and tech companies, continue to float to the top as Bitcoin becomes more valuable than data and oil. We'll see. I don't know. That's my thought, but
I could definitely see us talking more about this, and I know we want to get you out of here soon, so I'll finish this up, get to the implied vol stuff.
Cool.
I actually, believe it or not, started making this file before the CrowdStrike IT service outage happened, and I was like, oh, CrowdStrike could be like a great candidate for this. I still think they could be, but it was just one of those things. It's like, of course, a week after I started looking into CrowdStrike for this reason, they have a global IT outage. But the thing that really stood out to me about CrowdStrike is their price to earnings is really obscene. I mean, it's so obscene that I had to verify it myself, because like the logic that I'm using here is just like the PE. As you can see from here, I have like an if-else statement for if there's no PE to put a nothing. But I'm just using the PE that comes on Microsoft Excel. So I wanted to run the numbers myself, and the PE comes out to be like the exact same, like 440 versus 439. So this is like, extremely up there, and also very much extremely up there relative to everything else. So this could be like a good way of CrowdStrike diversifying their tech company with like another tech instrument. And then the other thing I want to talk about here more broadly, and this mostly applies to Tesla and CrowdStrike. I lost my mouse again. This mostly applies to Tesla and CrowdStrike here, where the volume average, meaning the average of the daily shares traded on a daily basis, the average volume, I look at that and I divide that by the total shares outstanding, and Tesla and CrowdStrike really trade like a fair amount of their shares every day, much more than any other company. it's funny here to like look at Berkshire's like 0.013 versus, you know, Tesla at 4%. Like no one's trading Berk A. It just sits there forever. It's almost kind of funny. But what this leads us into is like, you know, a first order volatility derivative, just in terms of like how much of their shares are actually moving around, and like as a way of trying to gauge that overall investor demand. And that leads us into this fun chart, which I find to be like very fun and aesthetically pleasing. But essentially what we're looking at here is there's no price or volume or anything. This is just the implied volatilities of the following assets: CrowdStrike in green, Tesla in red, MicroStrategy in the light blue, the VIX in white, the S&P 500 in purple, and the gold ETF in gold color. And what we're looking at here is we're looking at the past 5 years, and there's probably a couple things that stand out on this chart. Number one, where my mouse is now, this was the peak of the COVID crash. This is when the VIX peaked at, you know, just over 80, and it's unsurprising that the implied volatility of these assets, like, you know, rose up into that. As you go forward, there's a couple like interesting things that I think are noteworthy. Number one is that all of the assets, other than these two like comparison assets that I have here, the S&P 500 and gold, all of the assets are, you know, well above the S&P 500 and gold, which kind of speaks to the volatility premium that comes from the convertible bond strategy. In that, you know, I think it was Dylan LeClaire actually who said a couple weeks ago that MicroStrategy's bonds from a couple years ago were the best performing bonds in all of the corporate bond market, which is very interesting because I would imagine it's the volatility on the underlying that allows like the bonds to go up that much. Again, a lot of this stuff on the corporate bond side I might not be totally up to date on. Hopefully we get Dylan LeClaire and like we can like learn more about this stuff as we go. But the candidates, again, founder-led public companies and companies that happen to have, you know, a dramatically increased implied volatility between gold and the S&P 500, which is why we pivoted here to, you know, CrowdStrike and Tesla specifically. So as we keep going on, one of the interesting developments that unfolds is that, you know, MicroStrategy's implied vol overtakes the implied vol of the VIX itself. So this can be seen as like almost something of like a success story to a certain degree. Of course, this drawdown was like, you know, painful, and this was before I was in the stock, so I didn't feel this personally. But when we look at the melt up of recent, with the peak being in March of 2020, I mean, that was right here. The March of 2024, just, you know, 4 or 5 months ago, that was right here when we had like implied vol ripping upwards and the stock ripping upwards, thus increasing MSTR's ability to, you know, sell convertible bonds at attractive rates and all that sort of stuff. And MicroStrategy right now is basically like where the VIX is. These two numbers are pretty close. But again, the thing to wrap here on CrowdStrike and Tesla is that both of them are very much well elevated higher than the S&P 500, and they're both, you know, founder-led pubcos. I'm sure someone's going to be like, Elon wasn't the founder of Tesla. Well, Tesla had nothing when Elon got there. They had no employees and they had no intellectual property. So by default, Elon essentially is the founder. Okay, and that's coming from someone who's been critical of Elon of recent. So take that for what it's worth. But yeah, I mean, they seem like CrowdStrike and Tesla both seems like, you know, prime candidates for an increased like Bitcoin exposure in Tesla and the start of a Bitcoin exposure for CrowdStrike, because of the founder-led dynamic, and their implied volatility is well higher than, you know, the market average, let's call it.
So the concept being they could capitalize on the convertible debt market more efficiently than other companies with a higher implied volatility, because there's more incentive to hold that company's convertible debt, something like that.
Yeah, I mean, one of the things that I've learned as of late, as I've been like learning more about the convertible bonds, is that like the volatility is a desirable concept.
Yeah.
You know what I mean? And like if you look back here towards the beginning, like this was like right before, you know, MicroStrategy had a Bitcoin strategy. Of course, it was like a little bit higher than like the S&P 500 in gold, but it wasn't nowhere near it is now. And that these lows in like the cyan blue here, these lows are the lowest lows that it had. And the starting point for both, you know, CrowdStrike starting to buy Bitcoin or Tesla, you know, taking a more aggressive Bitcoin strategy would be way higher than like where MicroStrategy started. So I think they would be able to monetize that volatility premium in such a way that's ultimately accretive for shareholders.
Yeah. Brilliant. Interesting. Well, I'd love to get Dylan's perspective. Get him on the show. I mean, he's already agreed to it, so let's just get a date.
Yeah. Yeah, let's get him on.
Well, I've got to go to bed. It's a school night.
No, let's stay up and talk more.
It is fun. It is. Well, thanks everybody for listening. Quant Bros episode 7. This has been a ton of fun. We'll keep cranking out material. There's a lot of fun on the horizon. I am excited about the upcoming stock split. I think there's going to be a lot more retail traders coming in the door, and interest rates, all of that. I've got a lot to be bullish about, and I'm just sitting on my hand. Any intraday, change in valuation is just doesn't bug me too. That's all I've got. Ryan, your closing comment?
No, actually, yes. Now that I think of it, this is something I meant to say towards the top in terms of like a housekeeping note. Me and Jeff have kind of realized over the past couple episodes of having guests on that what we would rather do in the future moving forward is like really open up the conversation to like what the guest wants to talk about, and not us both be like fighting the urge to be like, oh, there's this cool thing like I want to talk about and share my screen on. This way we can like, fully learn from the guest and ask follow-up questions on the spot. And I think that'll end up being like the richest learning experience for all of us, both me and Jeff and the audience as well. So every once in a while, like today, we'll probably do an episode like this, or like perhaps me and Jeff will do an individual episode like the 6.5 one, just to get some of those topics like off our mind, so that when we have a guest, we can like fully, open up the show to them and ask what we think to be like insightful follow-up questions. But yeah, no, other than that, good to go. Lots to be positive. I'm sorry. There's a lot of positive things, in the future for us here. And there's a lot to be excited about.
Yeah, absolutely. Well, appreciate the time as always. It's been a ton of fun, and we'll look forward to the next one. Thanks everyone. Awesome. We'll cut it there. All right, man. Well.